Decade ago, property was an under-researched asset class. Today, this asset class is recognized and utilized amongst professional investors, both locally and globally. There are large real estate investment trusts, often with complicated underlying property investments. How does one invest in these? And maybe more importantly, how does one analyze this asset class? Gentlemen, on that note, I welcome you once again.
Thank you.
Cobie, let's start off with you. When I think of international property and property on a global level, one only has to look at, again, the bleak economic data that emanates from the US. We've got a lot of troubles that are still occurring in Europe, and of course, the most recent crisis coming out of Japan. Does this create a lot of concern, or do you think that this creates a lot of opportunity?
Well, remember that global property, and I mean, if you look at local property, I mean, some of those dynamics exist here in the South African market as well, is coming off a very low base. Internationally, certainly that is the case. And that has often been a very good buying opportunity. It signifies that it's a good buying opportunity. If you look at South African property a decade ago, and you made the point just now, it was a very under-researched asset class. Often disparate type listings, very small listings. And from that perspective, you saw very large double yield or double digit type yields for many of these listed entities. Certainly internationally, we've seen something similar, and that has literally over the decade been compressed down to single digit type yields. So the environment has certainly become far more conducive to investing for both international, well, for both what we call institutional investors and for private type investors. But there are differences, and this is maybe a question that we could maybe ask to Jamie in Cape Town. You know, Jamie, if you look at the international space, you see REITs being invested, and in South Africa we have what we call puts and PLSs, which is property unit trusts and loan stock companies. How different are those two?
Cobie, I think in South Africa the listed property market is actually quite well down the line and quite developed for an emerging market. And in all honesty, the difference between our PUTs, our property unit trusts, and REITs globally is not that different. They both are tax efficient structures through which you can get access and exposure to underlying direct property. The PUTs have a few slight differences where they have some constraints around what they can take their gearing levels to, although those are being relaxed, as well as the fact that they have external management companies. But in essence, they're fairly similar, and it's more a perception thing from global investors that South Africa doesn't have a REIT type structure.
Well, Jamie, I think let's take this even further. I mean, we're talking about the listed property space at this point in time, and of course, a massive difference when it comes to actually investing in a physical property. And I suppose we keep talking about the opportunities that we currently see in the UK and the US, but I think a point that I mentioned in the intro is that a lot of these listed properties have perhaps very complicated underlying property investments. Could you tell us a little bit more about this?
I think that might be a misconception then in the if that is the perception in the market. What you're gaining through the listed entity is access to large shopping centres, large office blocks, big industrial compounds across the globe. I would say, barring a few smaller markets, New York office market can be quite complicated because there's a lot of corporate finance type structures around how the properties are owned. But across the board and generally, you're owning a good quality, you're getting scale across a number of properties, and you actually get you physically, when you look through it all, you're owning a portion of that company's portfolio, which will be made up of the same things that people might own in a direct capacity, but you're getting scale by being able to, you know, in your personal or on a small scale, you would maybe only be able to own one large shopping centre. By investing in listed property stocks or REITs, you can get a diverse portfolio with thousands of tenants across different regions. You have liquidity where you can move around daily if you want to. So it's not as complicated as maybe the perception is out there.
Yeah, I mean, I think, Eleni, that is the important factor that you must take into consideration here, is that when you look inside a REIT structure, it's not just one building you're buying. You're buying often across a whole range of them, and then often you're trying to weigh up what we call industrial holdings, and you're looking at commercial holdings, or potentially also even retail holdings. And sometimes it's the diversification across those, and potentially also the combination of them that maybe creates a certain return for a specific portfolio. Maybe, Jamie, just another question for you. What are some of the fundamentals that you guys are looking at the moment, and potentially just that your process has got within itself in order to try and understand the REIT market better internationally?
Okay, I mean, from a process point of view, our first protocol that we look at is the underlying properties that the counter will hold. The quality of the property, as you said, are they in the office market, the retail market, the industrial market, are they in residential, are they in hotels? In the US, there's a lot of specialization that happens, and you actually have funds that are specifically focused on residential, or hotels, or self-storage, or whatever the case may be. So I think the underlying properties and the ability of those properties to grow rentals into the future is our first port of call. I mean, our valuation method is a discounted cash flow. So we do a 5-year discounted cash flow. We look at the earnings going forward. And obviously, what is important is what's going to affect those earnings. What are the risks and what are the potential opportunities within those earnings? So is their portfolio under-rented? So maybe the portfolio at the moment is earning £100 million, but actually market rent at that moment for that portfolio is £140 million. But the leases have to come up for termination before you can actually realize that value.
Quite a fascinating.
And there could be risks involved in that.
Yeah. Well, quite a fascinating point, Cobie, that Jamie mentioned them in the risks that are involved and what is actually driving the growth of a lot of these properties. One only has to look at the UK and, of course, the US to realize that within that retail market, I mean, you've got to look at the occupancy rates. You've got to look at the health of the businesses on the ground to know whether they're going to renege on their leases and whether the estimated rental values are being met, or are they renting below those levels. I mean, are these some of the risks that you perhaps are considering going forward?
I mean, it's their risks and their opportunities, because remember that if you're buying the business or the property portfolio at an inherent discount relative to that, well, what are you getting at the end of the day? You're getting a property portfolio at a discount that, from a rental perspective, will be able to give you some form of income, and you'll be able to get a share price catch-up, so to speak, relative to the fair value. I suppose that one of the biggest risks that you have in global property is across diversification. So if you look, for instance, at the UBS the benchmark, which is really global property, equities make up probably about 50%. So America makes up probably about 50% of the total index. Jamie, just give us an indication here quickly. The US makes up such a massive portion of the UBS index. Are you guys seeing a migration from a worker's perspective, maybe away from the west into the east? And is that influencing property prices? And how does that influence the valuation and the fundamentals that you guys are looking at?
Yeah, I think just looking at that, if we just cover, first of all, the US being about 50%, it's the most developed REIT market and listed property market in the world. It's had REIT status since the 1970s. So by virtue of that, and by virtue of the fact that it has got a large economy, it's always going to be a big player. It's probably bigger than it should be because of the fact that it's been around for so long. If we just look at the globe sort of from east to west, the fundamentals in the east, Hong Kong and Singapore in particular are particularly strong at the moment. Hong Kong Central at the moment, prime office rentals were up 40% last year. Forecasts are that they're going to grow another 30% this year and about another 25% next year. So that, fundamentally wise, they're on the front foot at the moment. I'd say Europe and the UK are somewhere in between. They're sort of just chugging along. A lot of the sectors have sort of reached the bottom, and in certain sectors they're actually turning the corner. The London office market, for example, had a really strong year last year. Look, it came off radically during the financial crisis, but city office rents in London were up 25% last year, for example, from £42.50 a square foot to about £50 a square foot by the end of the year. The US is probably weakest. Fundamentally, it's the weakest market, but as we were talking about earlier, that potentially means there could be the most opportunity there because vacancies have blown out. Now there's the ability for those companies to now fill those vacancies, and that obviously filters through to the bottom line. I think we're definitely seeing something of a shift towards the east when you see what the rental levels are in a market like Hong Kong, for example. Probably the most expensive office market in the world. I think comparatively, probably about triple the cost of Manhattan at the moment. It is an island, obviously, so there's not as much space, so supply can be an issue, and obviously that pushes rentals. But I think you're definitely seeing those markets have the potential to grow in size over the coming years.
Well, Jamie, on that point then, how do you then decide on a geographic diversification? Because you're talking about one market that is blowing the lights out. Some even say that the market in Hong Kong and China is in bubble territory. That's an aside comment, of course. And then you've got a lot of opportunity that could come through in the likes of Europe, UK, Ireland, and of course in the US as well. How do you decide on this? And if you could also just bring in the element of currency fluctuations as well.
Okay. Well, I mean, we look at it from the bottom up. We look at the stocks. I mean, in our index, there are about 233 stocks. We break that down into, we look primarily at about 100 of those stocks and do primary research on those and do valuations on those research. To break down to that 100, we're looking at best in class. We want coverage across asset class and across regions. And it generally covers about 75 to 85% of the market cap within each region. We want coverage of that. So you've got all the large caps in there as well. I mean, our valuation method is a discounted cash flow, so we're trying to predict what the recurring or sustainable earnings are going to be going into the future, and then obviously use a required rate of return depending on you built up from the long bond within the country that you're invested in, and other factors, specific company factors like what is their loan to value, do they have any concentration risk, management risk, or you might give them some benefit for great management, and that gives us a relative value. So, sorry, just to go back to it, the fundamentals may be the strongest in Hong Kong at the moment, but that might all be priced in. So it's relative to where they're trading. The fundamentals may be the weakest in the US at the moment, but that also might be priced in, so the stocks are cheap at the moment, if that makes sense. So we look at relative value-wise, relative where they're trading at the moment, where do we see the most relative value, and then build that up from each stock. It'll give us a regional allocation where we should be regionally based on where the relative value is in those regions. Okay,
very quickly, Cobie, you have to go to a break, but just give us a sense as to why investors should be heading into this global property space, because the crisis started with property. It could very well happen again. I mean, isn't it too risky?
Number one, much cheaper than it was in previous years. Number two, you're buying a physical asset, and if you get your yields right, like you should get right in any asset class, you're going to get long-term gains out of it. It's a great portfolio diversifier as well.